So how does BOFA work? Well, Bank of America participates not just in consumer banking, but also wealth management and global banking as well. The bank drives 37% of its revenue from consumer banking, 22% from its global wealth management, 25% from global banking, and 16% from global market management. In terms of net income, 41% came from consumer banking, 35% for global banking, 16% from global wealth management, and 9% from global markets. Bank of America makes most of its money from consumer banking, with checking and savings accounts as deposits for loans, credit cards, mortgages, and more. The business is rate sensitive, with the majority of its loan portfolio concentrated on commercial loans, so this can support the bank as interest rates rise. And we will go more in detail as to how this works, and we will talk about Bank of America's loan portfolio in the next few slides. Major investors have bought into this bank, with one of BOFA's largest shareholders being Berkshire Hathaway. Bank of America is 10.6% of Berkshire Hathaway's portfolio currently, and offers solid shareholder returns with sustainable long-term growth, and we will talk about this more in the industry analysis. Bank of America's market cap is around $293 billion, making it a mega cap stock, and the company was founded in 1998 from an acquisition by Nations Bank, although their history really dates back to 1904, when the bank was opened as the Bank of Italy in San Francisco. Now let's analyze the industry. Interest rates are on the rise, with the Fed raising interest rates from a range of 0.25 to 0.5% to the range of 0.75 to 1%, a half basis point increase. This is the first time the Fed has raised the rate by a half point in over 20 years. The last time was in 2000. It is expected that the Fed will raise the rate to near 2018 levels of 2.25 to 2.5%, and this would allow banks to generate significant additional income as they can raise the rate at which they loan money while slowly raising the rate for deposits, profiting off of the difference greatly in the short term. Now let's talk about rate sensitivity. Bank of America's loan portfolio is concentrated in safer loans, such as commercial loans, often backed by collateral, rather than more risky debt, such as credit card debt. Bank of America holds $421 billion in commercial loans, considerably more than most other banks, with Wells Fargo coming in second with $352 billion in commercial loans. These commercial loans are often used to fund capital expenditures that a business would like to perform to expand their business. Other banks, such as Citibank, hold more credit card loans, which are riskier and less sensitive to rising interest rates. Bank of America's next largest loan offering is residential mortgages and then credit card debt. Bank of America has done a fantastic job managing their portfolio of loans, and I think this can position themselves well for significant short-term profit as well as long-term earnings growth with a relatively safe portfolio. Bank of America's priced earnings is a relatively fair 10.67 compared to a BOFA competitor, JP Morgan Chase, which trades at a PE of 9.17. Bank of America's PE is higher than JP Morgan's, which is interesting at this time. However, these are close, and I'm not concerned about the difference since this is too small of a distinction. The Dow PE is currently about 18.8, while Bank of America trades at a much lower PE, and that can help suggest that there is an undervaluation of BOFA on the stock market. However, banks tend to trade at lower PEs, and the historical PE for Bank of America is near 12, which can also suggest that there is an undervaluation of Bank of America on the stock market. And for the price to book, Bank of America's price to book is fair relative to other companies in this field. Currently, BOFA has a PB of 1.13, and compared to JP Morgan Chase's, which is a PB of 1.27, BOFA has a fair PB. Bank of America's PB is also quite high relative to its past PBs, near 0.9, which is a bit concerning, although they are likely to grow book value considerably with rising interest rates and stock buybacks within the next year or two. I also want to note that this is a low PB relative to the S&P 500 PB of 4 currently. Remember, the lower the PB, the better. According to the debt to equity, Bank of America has a fair ratio compared to its peers. BOFA's debt to equity appears to be near 1.05, while JP Morgan Chase's is around 1.03. This is fair at this time. Lastly, for the return on equity, we see that Bank of America has an ROE of 10.9%, while JPM has an ROE of 14.01%. With Bank of America having a lower ROE than JPM, this can help suggest that Bank of America is handling its capital worse than JP Morgan Chase. Although Bank of America and JP Morgan Chase have both increased their ROE over the past decade. And of course, these are just financials and technicals, so we cannot base management directly off of these alone. In terms of the intrinsic value, the company seems to offer an upside of 72% due to the strong and positive free cash flow over the past 10 years. I do want to note, however, that DCF doesn't tend to work on banks since it is difficult to value banks as their earnings aren't as streamlined as companies like 3M, which reinvest in their business and sustains consistent free cash flow growth. After projecting the next 10 years of discounted cash flows from the past 10 years of cash flows with a perpetual growth rate, essentially the expected growth of the economy, of 2.5% to be conservative, and a discount rate or expected rate of return on investment of 14% to be conservative once again, the company has a discounted cash flow intrinsic value of $60.43 per share, relative to a recent closing price of $35.17. Now, I chose the perpetual growth rate and the discount rate to be very conservative because this valuation really doesn't work for banks. As a result, I wouldn't consider this intrinsic value to be as valuable for valuing banks at this time, but it could work very well for valuing other stocks. There are multiple ways to calculate the intrinsic value, and this is just one way, so please keep that in mind. Bank of America does buy back its own stock according to the shares outstanding appearing lower. When a company buys back its own stock, the book value per share increases and the intrinsic value increases per share as there are less outstanding shares in the market. However, this should only happen when the stock is believed to be undervalued because the money can otherwise be reinvested back into the company for growth, research, and acquisitions instead. In this case, banks tend to return capital to their shareholders through both dividends and stock buybacks. This is expected from a bank like Bank of America, and they can well afford to do this with their consistent free cash flow. In terms of dividends, Bank of America currently pays a dividend equivalent to a 2.36% annual yield with a quarterly dividend of 21 cents per share, so 84 cents per share per year. This is good as the company is trying to distribute some of their extra funds to their shareholders. Like I mentioned earlier, the company can reinvest this money, however, they are clearly determining that this money is extra and can be distributed to the shareholders without harm to the business. So overall, what do we think about Bank of America? BOFA appears to be slightly undervalued at the time of recording, in my opinion. The company has a relatively high price to book relative to its past PBs, and a relatively low price to earnings for the time. The intrinsic value is higher than the current trading value of the company's stock, which is ideal. However, other intrinsic values may suggest otherwise. Over the long term, I expect the earnings of Bank of America to grow with the expected rate increases and its growing loan business. Bank of America offers a decent dividend, and they do repurchase stock at this time. This stock appears to be a value stock and less of a growth stock in my view. This stock also appears to be a safe dividend stock that can offer returns for income investors for a long period of time.